The new year has started with one of the worst Januaries ever for stocks. It took the S&P 500 only 15 trading days to be down 10% for the year. A sense of vertigo is to be expected, as this is one of the fastest drops in the market ever to start a new year. Perhaps what precipitated this decline was the news that inflation rose at its quickest pace in 39 years, hitting 7% in 2021. The Fed has promised to respond by raising interest rates in March. So what has historically happened to the stock market when the Fed raises rates? Let's take a look. When the Fed raises rates, the purpose is to slow down the economy to prevent it from overheating. Higher rates make it more expensive for consumers to borrow, which reduces spending. But the idea is the Fed is raising rates because the economy is growing and is strong. This chart from LPL Research shows that higher rates are most often bullish for stocks, with a positive result 80% of the time. But what is the effect on the market after the first rate hike? If we watch the financial news, we may think it's a disaster. But history shows stocks often do well. For example, since 1983, after each rate hike, the market was favorable in 12 months. The market does not like uncertainty, and a change in the direction of Fed policy and the high inflation numbers we're seeing from last year is uncertainty. But there's another possible reason for this market correction we should consider. As Ryan Dietrich, Chief Market Strategist at LPL, recently pointed out, we haven't seen a 10% correction since March of 2020. That's a long interval. 10% market corrections, as this chart shows, occur on average once per year. In other words, we were due, and corrections are a normal part of how the market works. If you have questions about the recent market action, please give me a call or visit my office. We're not in it for the short term, not even until inflation is back to normal levels. We're in it for the country mile.